Welcome to the deep dive. Today, we're jumping into a topic that's just been, well, everywhere: Bitcoin and the whole crypto market scene in 2024. You've given us a really interesting mix of sources to dig through. We've got market reports talking about Bitcoin's incredible run, but also some pretty sharp critiques from central banks, and even a look at what some industry folks are saying about where things might be headed. So, our mission today, basically to unpack all these different viewpoints. We want to help you get a clearer picture of what's driving crypto, the big criticisms it's facing, and what it all means for how it keeps evolving. It really is a classic story, isn't it? Rapid growth hitting some intense scrutiny.
Absolutely. And what's fascinating, I think, is how you can have the same events, the same market moves, but interpreted so differently depending on who you ask. So yeah, we'll try to connect the dots between the raw numbers, the economic arguments underneath, and maybe some of those big visions for digital assets, hopefully giving you a full picture without drowning in jargon.
Okay, let's start with the headline story then. Bitcoin's performance in 2024. It was pretty remarkable. Our first source here from Profit by Pakistan Today calls it Bitcoin dominates 2024. And the numbers seem to back that up. It says Bitcoin more than doubled. Started the year around, what, $40,000?
Yeah, around there.
And ended up near $94,000 by December. But even more, it hit an all-time high over $108,000 mid-December.
Wow.
Apparently, a lot of that later surge was tied to optimism after the U.S. election, people expecting maybe clearer regulations.
Interesting. And Ether saw some gains too, right?
It did, yeah. Up nearly 50%, closing around $3,355. So significant, but maybe not quite the Bitcoin story.
Right. And a big piece of this puzzle, especially earlier in the year, was the launch of those Bitcoin ETFs back in January. That was a major catalyst. Suddenly, it was much easier for, let's say, traditional investors to get exposure.
And the money flowed in?
Oh, yeah. Tens of billions of dollars. The iShares Bitcoin Trust,
Yeah.
beat, that one alone pulled in over $50 billion in assets under management.
50 billion.
Just one fund. Just one. And then, Ether ETFs followed later. In July, they drew over $2 billion in their first 6 months.
Okay, so still substantial, but maybe the appetite wasn't quite as ravenous as for Bitcoin initially.
Seems that way, yeah. Less demand compared to Bitcoin's ETF launch.
And it wasn't just the coins themselves performing well. Some related stocks did too. MicroStrategy, for instance, soared over 360%. Got added to the NASDAQ 100, actually.
That's huge for them.
Yeah. And Coinbase, Robinhood, also strong gains. 43% and 196%.
But not everyone in the ecosystem benefited equally, I gather.
No, that's a good point. The mining stocks like Mara Holdings and Riot Platforms, they actually faced double-digit losses.
The halving effect.
Exactly. Bitcoin's having cut the block rewards, which directly hit miner profitability.
Right, so that raises an interesting question, doesn't it? You have this market euphoria driven by ETFs and optimism, but then you have the underlying economics, like mining costs and broader factors like Fed rates.
And prices did ease off a bit towards the end of the year. The source mentions slower than expected Fed rate cuts and some profit taking.
Naturally. But the key thing, I think, is that structural shift from the ETFs.
Yeah.
That access point for institutional money, that seems pretty baked in now.
Yeah, that structural change feels important. Another source we looked at, a discussion on the Wolf of All Streets, really hammered home the impact of those ETFs. They called it astonishing.
Astonishing. I like that word for it.
They pointed out that Bitcoin ETFs altogether saw $37 billion in inflows in their first year.
Okay, $37 billion.
Yeah.
How does that stack up historically?
Get this, 6 times larger than the previous biggest ETF launches, like GLD for gold or QQQ for the NASDAQ.
6 times. Wow. Okay, that puts it in perspective.
It really does.
And you see that reflected in individual firms, too.
Yeah.
Bitwise, for example, they mentioned going from $1 billion in assets to over $12 billion in, what, 2 or 3 years?
Well, yeah, 24 to 36 months.
And they put that down to getting onto major platforms. Morgan Stanley, Wells Fargo, Stifel, and, crucially, providing research to those big institutional players.
So it wasn't just about access, but also about education and building comfort.
Exactly. It signals a real shift in how the big financial institutions are not just looking at crypto, but actively engaging.
And apparently, this momentum wasn't easily derailed. The source noted inflows continued even when geopolitical tensions were high.
Interesting. Like a secular trend, as they put it.
Yeah, that was the phrase. Some argued it made crypto somewhat immune to broader market shocks. Maybe a strong claim, but reflects the sentiment.
And the investor mindset they described.
All dips are for buying. that was the quote, suggests people weren't just trading, but taking a longer-term investment view.
Right, a HODL mentality, maybe extending into the institutional world. And this isn't just a Bitcoin story, according to them.
No, they were looking beyond. There was talk about Solana ETFs being potentially the next natural darling.
Solana, okay. So broader institutional interest across different crypto assets.
Seems like it, even though, as they noted, a really robust, regulated futures market for Solana isn't quite there yet.
So the appetite might be outpacing the market infrastructure in some cases.
Could be.
Yeah.
It definitely shows the conversation is widening beyond just Bitcoin. Okay, so that's the high-flying, optimistic side of the story, but we need to bring in the counter-narrative.
Right, and it's a pretty strong one, coming from the European Central Bank, the ECB.
Yeah, their blog post title says it all. ETF approval for Bitcoin, the naked emperor's new clothes.
Doesn't mince words, does it?
Not at all. They flat out argue Bitcoin's fair value is still zero.
Zero. So how do they justify that? It flies in the face of, well, the market price.
Their core argument is about utility. They say Bitcoin completely failed on its original promise being a global decentralized digital currency.
Because?
They say transactions are inconvenient, slow, and costly, and that outside the darknet, it's hardly used for payments at all.
So failing as a medium of exchange, in their view.
Pretty much. And then they go further. They argue it's not suitable as an investment either.
Why not? People are clearly investing in it.
Their reasoning is it doesn't generate cash flow like real estate does with rent or dividends like stocks.
Okay.
It can't be used productively like commodities in industry. It doesn't offer social benefit like, say, gold jewelry or subjective appreciation like art.
So basically they're saying it has none of the traditional hallmarks of an asset with intrinsic value.
That seems to be the crux of it,
Right.
which leads to the obvious question.
If it's fundamentally flawed, why the resilience? Why the price?
Exactly. And the ECB offers three main reasons for what they call its seeming resilience.
Okay, what are they?
1, ongoing price manipulation in an unregulated market. 2, growing demand from illicit activities. And 3, what they term authorities' misjudgment.
All right, let's break those down. Price manipulation, what's their evidence?
They cite a Forbes analysis from 2022 suggesting over half, 51% of daily Bitcoin trading volume was likely bogus.
Bogus how?
Things like wash trading, where the same entity is basically trading with itself to inflate volume and create a false sense of activity.
Ah, okay, a classic manipulation tactic.
Right. They also mentioned pump and dump schemes. Remember that fake SEC tweet about ETF approval that caused a price spike?
Vaguely, yeah. That was a hack, wasn't it?
It was. And they also point to whale manipulation, large holders potentially moving the market.
Which they argue is easier when liquidity is low.
Precisely. The article notes that during the crypto winter, when daily trading volume dropped significantly, market interference had potentially more impact.
Makes sense. Lower volume means bigger ripples from large trades. Okay, what about the second point, illicit use?
The ECB asserts Bitcoin remains the top choice for money laundering. They quote figures like $23.8 billion in crypto transferred by illicit addresses in 2022.
$23.8 billion. That's a huge number.
It is. And they also mention ransomware payments surging to $1.1 billion in 2023. So they're painting a picture of crypto heavily fueling criminal activity.
A narrative that's been around for a while, but they're putting some stark numbers on it.
Definitely. And their third point, authorities' misjudgment.
This sounds like a critique of regulators.
It is. They argue authorities were initially hesitant to regulate, maybe because Bitcoin seemed so abstract.
Yeah.
And while Europe brought in micro-regulations, they focused more on stablecoins and service providers, not really constraining Bitcoin itself directly.
And in the U.S.
They point out the SEC was essentially forced by a court ruling to approve the spot ETFs, even though the agency itself had voiced concerns.
Concerns about it being speculative, volatile, used for illicit stuff.
Exactly, the very things the ECB is highlighting.
So the ECB's take is pretty damning across the board. Utility, investment value, market integrity, regulation.
It really is. But they also argue that authorities can act despite the decentralized claims.
How so?
They emphasize that Bitcoin offers pseudonymity, not total anonymity. Transactions can be traced.
Right. The blockchain is public, after all.
And they give an example. Even so-called decentralized autonomous organizations, or DAOs, like Barnbridge DAO, have faced legal action.
Showing that even in decentralized setups, individuals can potentially be identified and held accountable.
Yeah, so the ECB is basically saying It's flawed, it's manipulated, it fuels crime, and regulators can do something about it, even if they haven't fully.
Wow. Okay, that's a very different perspective from the ETF euphoria.
Completely different. So how do we bridge this gap? Let's zoom back out a bit, maybe towards the more bullish future outlook again, particularly around stablecoins and broader adoption. That Wolf of Wall Street source was quite optimistic here.
Right, they talked about the potential impact of stablecoin legislation in the U.S.
Yeah, the Genius Stablecoin Act, they called it. Expected to pass with bipartisan support, which they saw as a huge move for the industry.
And the significance of that would
They
be
see it as a catalyst, like opening the door for a potential crypto IPO market explosion.
IPOs.
Yeah.
Interesting. Which companies?
They mentioned Circle, whose stock apparently surged to $165, and Tron possibly going public, driven by their stablecoin businesses.
Ah, so stablecoins become the regulated, perhaps more palatable entry point for public markets.
That seems to be the idea. And this IPO boom, they believe, would then accelerate VC investment because valuation windows for crypto firms would jump.
Okay, so it creates this positive feedback loop.
Yeah.
Regulation leads to IPOs, which leads to more venture capital.
Exactly. Leading to what they termed base layers of new capital coming into the crypto space.
Beyond just the ETF money we talked about earlier.
Right. And related to this is the idea of Bitcoin treasury companies or Bitcoin balance sheet companies.
So companies holding Bitcoin on their books, like MicroStrategy, but maybe more widespread.
Yeah, basically any company, public or private, deciding to allocate some percentage of profits or revenue into Bitcoin.
Seeing it as a way to boost their own valuation, perhaps?
That's the suggestion, a fundamental shift in how corporations view Bitcoin as a treasury asset.
And projecting this forward, what's the big vision they're painting?
It's pretty ambitious. A world where, quote, every person in America or every person around the world has a crypto wallet within a few years.
Everyone. That's bold.
It is. They see stablecoins growing massively from $250 billion today to potentially $10 or even $20 trillion.
Trillion. Okay. And how does it translate into daily life?
It means everyone being one click adjacent to DeFi, decentralized finance, a future where crypto is completely normalized.
Normalized how? Like paying for coffee with USDC?
Maybe eventually. But they mention things like single sign-on, using your crypto wallet for shopping or web interaction.
Like using your Google or Facebook login today,
Yeah,
but with a crypto wallet instead.
exactly. They pointed to integrations already happening with Shopify, PayPal, Cash App as early examples of this trend.
So crypto moving from just an investment asset to actual integrated web infrastructure.
That seems to be the vision. And alongside that, we also heard about some innovative financial products being built on crypto.
Like what? Beyond just holding or trading.
Yeah, ways to generate yield from the volatility itself.
Right.
We heard about algorithms, like from Arch Republic, designed to extract cash yield from crypto holdings.
Extracting yield from volatility. How does that work, roughly?
Well, the claim is these systems can generate significant annual yield, maybe 20%, plus total returns around 25%.
By doing what? Trading the swings.
Essentially, yeah. Leveraging volatility to systematically buy more of the asset when it dips while also generating cash. It's complex, but the idea is to turn volatility into an advantage.
And maybe help investors ride out those wild swings emotionally, too.
That was part of the pitch, yeah. Managing the psychological side of crypto investing.
So you got ETFs bringing in institutional money, potential regulation paving the way for IPOs and stablecoin growth, companies adding Bitcoin to treasuries, and new financial tools being built. It paints a picture of deeper integration, doesn't it?
It really does. Which brings us back to the tension with traditional finance.
Yeah, how does the old guard react or adapt?
Well, the source acknowledged there will be roadblocks. They mention things like intentionally difficult AAT transfers, getting money between traditional banks and crypto exchanges.
So some friction points remain, maybe deliberately.
Seems likely. But the overall sentiment was still towards this transformative future. Tokenizing real-world assets, blurring the lines between a crypto wallet and just a regular digital wallet.
Making it all feel more seamless eventually.
That's the idea. So quite a journey we've been on in this deep dive, from those record-breaking rallies, fueled by ETFs, and that post-election optimism.
Right, countered very sharply by the ECB's fundamental criticism, zero value argument, manipulation concerns, illicit use.
Exactly. And then layered on top, these powerful industry forces pushing hard for wider adoption.
Stablecoin laws, IPOs, the vision of wallets everywhere. It's clear the debate isn't over. Far from it.
Not at all. It feels like it's constantly accelerating, actually.
So as you listen to all this, these clashing perspectives, what really stands out?
Yeah, thinking about this digital landscape just racing ahead, how do you see this tension playing out between the innovation, the need for regulation, and that fundamental question of underlying value? What do you think shapes the next chapter for crypto?